All right, so most people think about real estate as appreciation, possibly rental income. But what if I told you that there are investors buying properties, especially here in Florida, and legally paying little to no taxes on that income? And the crazy part, most agents don't understand this at all, and most buyers are never told about this. All right, so today I brought on someone who built a huge portion of his wealth executing these exact strategies, John Chen. Most people think that if you've got the cash, you should buy the house outright, no debt, no payment, no stress. But what if I told you that's exactly how a lot of people lose money in real estate? Hey there, if you're new to the channel and you want to learn everything there is to know about living in New Smyrna Beach and surrounding areas like Ormond Beach, Daytona Beach Shores, Ponce Inlet, Port Orange, and Edgewater, then you have come to the right place. My name is Matt Ecoff. This is my beautiful wife, Rachel Ecoff. We're local real estate experts. We're here to share everything from the best neighborhoods to the hottest spots around town. Listen, we get phone calls, emails, text messages, Zoom invites every day from people just like you wanting to move to the beach. So whether that's 2 days, 20 days, or 200 days, please don't hesitate to reach out. We'd love to help you move to the beach. Please make sure you hit the like button and subscribe to get all the updates and notifications about New Smyrna Beach and surrounding areas. Okay, so today we're with my good friend John Chen. John has made the majority of your wealth in what we're going to talk about today, which is tax strategies with buying and selling real estate, more on the buy side, not so much on the sell side. And I want you to make sure that you stay till the end because we're going to use real, actual examples on 2 different properties that we're going under contract on today that are investors taking advantage of these strategies. So this is the reason why this was such an opportune moment, because we have real world examples that we can use, and they're really kind of 2 extremes. We have a $3.3 million home that we're sitting in right now that brings in an average of $36,000 in rental income a month. Yeah, over $264,000 in rental income this year with just barely booking at 50%. And then the other 50%, the owners are living. And then we have a 2-bedroom, 2-bathroom condo co-op in North Beach that rents 88.5% of the year on average over the last 5 years and brings in $63,000 in net income. We're going to explain how to break those down. So let's go right into it with the DSCR. Most people don't know that. Can you explain to me and to Rachel what DSCR loan looks like in leverage?
Yeah, so you had touched on how a lot of people don't take advantage of the returns they could achieve if they pay cash. And a big part of that is because of missed opportunity costs, because they're putting all of their money into 1 property or 2 properties when they could actually have 4 or 5 that they're benefiting from for all the different ways you can benefit from an investment property. But a DSCR loan, to answer your question, stands for debt service coverage ratio. It's a way to get a loan where your personal credit isn't being underwritten, so you don't have to put up any income statements, tax returns, or anything like that. You're literally the appraisers coming out to the property and looking at the income it makes, and then underwriting a loan based on the fact that it brings in this much money every month, and you can get up to a loan that matches that amount, plus your HOA if there is one, taxes and insurance. So it's a way to get a loan without you having to get your personal credentials underwritten, just based on the income on the property.
So we're sitting in this house it's 202 South Atlantic Avenue. Look it up, and when you do, it's going to be sold at that point. But nevertheless, look it up because I have other ones like this one. 202 South Atlantic is a 7-bedroom, 5-bathroom home, 4,200 square feet, over 4,200 square feet, pool home next to Flagler Avenue, overlooking the ocean, rooftop deck. Books are only about a 50% rate right now, but with 65 to 70% rate, if it was really managed the right way, this would easily make $350,000, $400,000 a year. This would be a perfect example of why somebody would get a DSCR.
Yeah, 100%, because a lot of properties these days don't make the incomes that they used to because property values went up, the rent incomes didn't go up proportionally as fast. So your returns got squeezed over time. So it's rare that you find a property like this that makes this kind of income that you could even afford to get any kind of loan on. So a lot of times, it used to be that you could buy a rental property, use an easy example, a $200,000 house that makes $2,000 a month. We call that a 1% rent multiplier because the money coming in is 1% of the purchase price. And with those kinds of incomes on that purchase price, you can go get an 80% loan at a 5% interest rate and get great returns, cover your loan payments, cover the taxes, the insurance, and maintenance on the house, even property management fees. But nowadays, it's really hard to find income that's high enough to be able to cover any amount of the purchase price that you're going to get a loan for, especially at today's interest rates. So this one works really great because you can get some leverage, some debt on it, and still cover your carry costs, even at a little bit higher interest rate.
Yeah, and we're going to talk about 5 kind of tax strategies around this, and this one qualifies for literally every single one of them because it's in the short-term rental zone. It's it's the size, it can be managed itself. It's sub 7 days. So DSCR, first thing that we're talking about today is buying a property that can pay for itself, where you don't have to qualify. This would be great for, I would think, like entrepreneurs. I think for people like dentists and doctors' offices that own their own practice, high net worth individuals that don't have to use their money, right?
Yeah, 100%. I know in my personal case, because I have assets in trusts, an underwriter is going to want to know what's behind all your trusts, and then it becomes a nightmare of paperwork just to prove what you have. And so people who have properties in trusts or entities that they're trying to hold properties for either as asset protection reasons or estate planning reasons. So if you have complicated structures like that, it's very hard to get underwritten. And to your point, if you have P&Ls versus a W-2 income, it also becomes harder to get underwritten. So for all those reasons, you have people migrating towards DSCR financing because it's just so much easier.
So they're kind of buying a business. I mean, they're buying they're buying a rental business.
When is it appropriate to start looking at this type of loan versus what you just said, like a traditional type of loan?
I think it really starts with what their underwriting position is. If it's going to be easy to get financing and they don't mind going through submitting all their tax returns, their income statements, pay stubs, and so forth, then they can get a slightly better rate with traditional financing and maybe even a higher loan to value, a bigger loan relative to the purchase price. But if you don't want to deal with all of that and the income is sufficient enough that it justifies paying a little bit more in interest, then it's much better just to go the DSCR route.
Gotcha. But let's talk about DSCR real quick, just on a couple of the caveats that we have. You were just checking with your investor that writes these loans, and she would go up to $5.5 million. So after that $5.5 million, it's probably not going to qualify, and also requires a 25% down. So these are just things I want to mention, because if this is something you're thinking about, everything has to qualify to meet those. All right, so the second part that we're going to talk about is cost segregation. I really like cost segregation, but I'm going to let you dive deeper into it.
Yeah, so the simple explanation of what cost segregation is, a cost segregation study is what's required for you to be able to take a much bigger write-off on the property, the depreciation of the property. So anytime you invest in real estate as an investment or income producing asset, the IRS says, well, we know that physical structure is deteriorating over time, so we'll let you take a paper loss or depreciate that asset. So you get these tax write-offs. It's kind of a credit for the physical property is deteriorating over time or depreciating. So cost segregation and bonus depreciation, they come together, they go hand in hand. So for you to take bonus depreciation as opposed to kind of stringing out what we call straight line depreciation, that paper loss over time, where you can get a lot of it, you can front load it the year that you actually close on the property. And the difference here, what I'm talking about is like on this particular property here, $3.3 million house that's making really good income will translate to about a $400,000 or $500,000 write-off, literally the year that you close and you buy your fund.
That's huge.
So do the math. If your effective tax rate is 30-40%, that's how much. Take that 30-40% times that $500,000. That's what you're actually saving that year.
So high net worth individuals, instead of paying taxes, you buy a property.
Yeah, and by the way, to qualify that, there are qualifiers. So consult with your tax pro. This is not tax advice. This is just education. Yeah, but if you qualify for that, then you get a cost segregation study, and what that essentially does is somebody actually says, okay, your property value can be broken down into 4 different types of costs. One of those costs is the land improvements. One of those costs is the building. One of those costs is personal property inside of the house. And then the one you can't depreciate is the land value. So the IRS says, we know the land's not depreciating, but these other 3 are depreciating, and a big chunk of those other 3 you can write off that first year. And that literally just came back because that was introduced in 2017. It started to get phased out in the last few years, and then last year they reset it to where you get 100% of that credit. So you have a lot of investors coming out.
Last year in 2025, because if you're watching this in 2030, things might have changed. So
yeah. So now you have all these investors coming out of the woodwork when they found out that that bonus depreciation schedule got reset to where you get 100% of that again. And now we have investors looking to buy properties like every year so they can get that big write-off every single year.
So then the bonus depreciation was my next topic. So tell me the difference between cost segregation and bonus depreciation.
So cost segregation is a study that is required to bonus depreciate your property. So they're kind of one and the same, compared to what we call straight line depreciation. So the difference between those two camps is straight line depreciation on a residential property. You can literally take, if you have a $300,000 house, to use round numbers, and $50,000 is the land, the other $250,000, which is the improvements of the house, take that $250, divide it by 27 and a half years, and that's how much you get to straight line depreciate every year.
Okay.
If you do bonus depreciation, you're saying, hey, that $250, I can chunk into 4 different categories of costs, or 3 categories of costs, and I want to take the bulk of that the first year. And so you're really just kind of front loading all of that paper loss the year that you buy the property.
Yeah, because I would think, and maybe I'm wrong on this, but I would think that, if you're taking over 27 and a half years, how many times do you change out the water heater? How many times do you change out the HVAC system? How many times do you change out your pavers or painting the house? Like, all these things should be able to be depreciated early, not over 27 and a half years.
Right. And that's why people do it. And then the following year, they want another big knock off of their AGI. The year after that, they want the same thing. And so they just keep buying houses.
So question, if they can do it all in 1 year, can they also spread it out and say, hey, I'm going to do X amount in year 1, I'm going to do X amount in year 2, X amount in year 3?
Yeah, they have the flexibility to do that. Or some people, even though they have the option of bonus depreciate, they just prefer to take the straight line. They don't have to do a cost segregation study. That's any accountant or CPA can do that for their filing. And it's a lot simpler to just do it that way. But for $500, you can get a cost segregation study at DIYcostseg.com and literally have that written up and then hand that to your tax pro.
Right now, the people that are managing this property, the sellers, they manage 7 other properties in New Smyrna Beach, and they are managing it themselves. They're bringing in the rentals, they're talking to the people. They do a little bit through Airbnb, but they're managing everything. As you know, they come in and they oversee the cleaning, and sometimes they do the cleaning themselves. So that gets us into our part 4, which is the material participation. And so explain how people can use that as a tax benefit as well.
Yeah, so one qualifier is that the IRS never lets you take a loss, like a paper loss, like depreciation, on a passive investment and apply it towards your active income. So you have a lot of executives, you have a lot of business owners that they don't qualify as real estate professionals or full-time investors, but if you have a property that rents on average less than 7 days at a time, and you are materially participating in running that operation, now the IRS says, okay, so you're involved over there to some extent, you meet that criteria. So now we can call that like an active operation that you have. Now that paper loss, you can apply towards your non-real estate investment active income.
Loopholes everywhere.
Loopholes everywhere, yeah. And so our current owners would, because they're so involved, would qualify for.
Yeah, they 100% qualify, and I'd be surprised if they didn't do that.
Yeah. Let's talk about this. Also falls under the 7-day sub average. Can you kind of get into that? Because rental zones are different. I mean, especially we're sitting here in New Smyrna Beach, where you could go 2 streets over and be outside of the historical area, and now your minimum rental is 30 days. You could get into a nice, great investment condo, but there might be rentals minimum 3 months.
Yep.
So how does the 7-day sub help and advantage, again, this property itself?
Yeah, so that's one big hiccup. You'll find a lot of investors that are chasing bonus depreciation. They make the mistake of buying a short-term rental, and then it doesn't rent for less than 7 days at a time, which is the qualifier or the requirement that if you're not a professional investor, you're not a professional real estate person, then the only exception to where you're able to take this big bonus depreciation write-off is if you're participating in the operation and it rents for less than 7 days at a time. So if it doesn't, and you got a monthly rental or something that requires 12-month leases, and you're not a professional investor, you don't meet those check marks for the IRS, then you can't take the bonus depreciation. You can still straight line depreciate it, but you can't front load that loss for your taxes.
Yeah. So again, we're talking about real world examples. We're sitting at 202 South Atlantic Avenue, listed for $3.3 million, is available for a DSCR loan because of how much it makes. It would qualify for cost segregation because of how big the house is and how much it has. It would It would work for bonus depreciation because the material's in the house and the accessories and the furniture and everything that comes with it. It is in sub 7 day. And it also would qualify for material participation, right?
Yeah,
and it literally qualifies for everything on this, which is what makes, this on a conservative number, $400,000 to $500,000 in tax benefits from owning this property, for buying this property.
Yeah, exactly. The only other box you have to check is make sure that you personally qualify, and that's something that you would do with your tax pros.
Gotcha. Yeah. Which again, this is not tax advice. We're just talking about loopholes, and I love loopholes, and I know you like loopholes too. I'll say as believers and Christians, the Bible says render unto Caesar what is Caesar's, but no more. And so the IRS takes advantage of every loophole they can for us. And so we feel like if there's a gray area loophole for us to take advantage, I'll give Caesar what's Caesar's, but I'm not giving him any more than that. So let's pivot for a second and talk about 537 North Atlantic Avenue. So we're just 100 yards down the street, but we're in North Beach, but we are still in the short-term rental zone there. So we can do a single day, we can do all the way up to, months at a time. This property is $750,000 listed. Again, it's going to go under contract for $750,000 today. It does weekly rentals, but they can do low rentals. This is a proprietary lease though, which means it's a share. So you're buying one share, 1/45th of an 8-acre property with 366 foot of ocean front. So the property is appraised at $55 million. So one day, Ritz-Carlton or somebody's going to come in there and they're going to buy the whole 8 acres with 366 foot of ocean front, and everybody's going to cash out for well over $1 million and make some money. But they sell for, anywhere between $450,000 and $750,000. This would be the highest sale in the place. But $750,000 for the share, which gets you the proprietary lease in the unit itself. It's got an 88.5% booking rate, brings in $63,000 net a year after cleaning fees and everything, rental fees. What would be the difference on a buyer there versus the buyer here?
On its face, it sounds like the numbers are higher relative to the purchase price, first of all, because the occupancy rate there.
Yep.
Secondly, the quick rule of thumb when you're trying to calculate, okay, what does this mean for my taxes at the end of the year, is if you're going to bonus depreciate and cost seg, then you just take the purchase price and you multiply it times about 20%, maybe 25% on the high side, and that translates to how much you'll be to write off. So a $700,000 property, it's going to be $140,000 of write-offs to $150,000 probably. So if your effective tax rate is about 30% or 1/3 is what you get back and you feel in your tax savings at the end of the year, that condo at $750,000 probably going to translate to about $30,000, $40,000 of tax savings the year that you buy it. So, but that's cash only, and that would be if you financed it or paid cash. So regardless of whether you got any kind of financing or not, you purchased that property that year, regardless how much of that purchase price was covered by debt, you still get the full write-off that year. But with financing, I think where you were going with this was the interest on that loan, you get to also write off.
Exactly. Well, I was going to say, we did an example, and we're going to do a voiceover, and then you can actually go through and we'll show the chart itself. And so we'll have something for you guys. It's really awesome. I would definitely take a look, get a remote out so you can press pause to look at some of the stuff that John's going to go over. But, there is a big difference between financing half the deal and paying cash for half the deal, keeping all that cash, spending some of that cash, and you can't do that on a share because you can't finance a share. And this is a co-op. So, I just wanted to make sure the audience knew there was a difference between what you could do here versus what you could do over there. Although the rent rules are very similar, and and they're both making themselves money and qualify for these things, except that one wouldn't qualify for the DSCR.
The numbers on a established single family home, pool home, right there at a prime A location, ground zero of Flagler Avenue in New Smyrna Beach, literally right across the street from city parking, and the end of Flagler Avenue where you can drive onto the beach. So this is 202 South Atlantic Avenue. It's a 7-bedroom, 5.5 bath, just under 4,200 square foot, single family home, sleeps 16 people. And like I said, it's got established income already. I'm going to break down just the high level numbers, and so that you can understand the sheet here. The far left section is just the inputs or the base assumptions that we're going to make, that the rest of the sheet will turn into what does that return look like if I'm putting, in this example, about $3.4 million out of pocket. how much am I getting back at the end of the year after expenses and based on some conservative income assumptions on your occupancy rate, the average daily rate, and so forth. So we're going to demystify the financials on this property. And then we're going to answer the question, how much financing can I get on this property, assuming today's current rates and different loan products? So we're going to see if will this property cash flow positive if you were to get a certain portion of that purchase price financed, as opposed to paying all cash, which comes with a couple other benefits that you don't have if you pay cash for the property. So just high level, on the left here, let's go over some of these assumptions. The money out of pocket pretty much consists, it's turnkey, so there's no rehab costs. It's already comes completely furnished with very high-end furnishing, fixtures, and accessories. So it's already designed and ready to go. 3.3 million purchase price, nothing out of pocket for rehab or design. We have some closing costs. So total money out of pocket about 3.4 million. The income assumptions are about $1,500 per night. That's more per night on holidays and weekends, obviously. It's seasonal, but your average is going to be about $1,500 per night. About 2/3 of the year is going to be occupied. So that'll bring in about $356,000 of income. Then we have some expenses that we're going to deduct from that, from cleaning fees, not cleaning fees, but you have consumable costs, you have property management fees that are already baked in. So if you don't want to adopt a second job as an operator of a vacation rental that has income history and bookings on the calendar already, then you don't have to worry about that. This is a complete turnkey investment for somebody who does not want to deal with bookings, rent collections, and cleaning and so forth. So the property taxes, the insurance, there is no HOA. We have lawn pool, pest control, utilities. These are all expenses we deduct from that income, totaling about $150,000. That leaves you with about $207,000 in net income. That $207,000 in net income is about 6% return on the $3.4 million out of pocket if you pay cash. Now, if we were to get some financing on this, and you don't want to put all of your cash into one property, you maybe want to buy two properties, because we have a lot of investors taking advantage of bonus depreciation for the big write-off. This property right here, if you qualify for bonus depreciation, will give you about $400,000 to $500,000 of tax write-offs literally the year that you buy the property, whether you get financing or pay cash if you qualify. And that translates at a 24% tax rate. That's going to translate to $100,000, $150,000 of tax savings the year you purchase. So we have a lot of investors trying to take advantage of that right now. And if you put 50% down, that leaves you 50% of your cash to buy another property similar to this as an example. But we always want to be sure that the property will at least cash flow or carry itself if we were to get some financing. So if we did 50% down and we went with for example, a DSCR loan, debt service coverage ratio loan, then you can get underwritten based on the income the property produces. You don't have to put up your own documents and tax returns and so forth to get personally underwritten. The property will underwrite itself based on the income it produces. So if you were to get financing on it, instead of being out of pocket $3.4 million, you're only out of pocket the half of the purchase price in this example of 50% financing. So about $1.6 million plus some closing costs. And that's going to put you at about a $5,000 monthly cash flow on average per month, even with the 50% loan in place. And the four ways that you win on an investment property, an income producing property, is not just on the cash flow. That's just one financial benefit. Let's quantify the other three financial benefits. You have, even if you didn't take advantage of the bonus depreciation and cost segregation, let's say you just straight line the depreciation on it. On a very conservative basis, you got $76,000 write-offs every year for 31 years on this in straight line depreciation. You got another $130,000 in tax write-offs from just the interest on your loan. That's about $208,000 of write-offs that you have with this property versus if you didn't have it. If you're at a very conservative 25% effective tax rate, that's about $50,000 literal tangible tax savings in your pocket. Check with your tax pro to make sure you qualify for that. But that's a tangible benefit and tax benefit. You've got after-tax cash flow. You've got principal reduction on that loan. So you're building equity not just from appreciation, which is about $105,000, assuming a 4% appreciation rate, but you also got just under $14,000 of principal reduction because the guests who are staying in the property are paying down your mortgage for you. and that number gets bigger and bigger every year you get into the amortization schedule. So long story short here, on half the cash out of pocket, about 1.6 million, you're making a total tangible return, if you quantify all the benefits of owning income property, about 216,000. That translates to about a 13% return on your cash. And you get, if you qualify for bonus depreciation, then you can get up to about $400,000 or $500,000 of tax write-off just from depreciation alone the year you purchase the property. So that's just a quick summary of the numbers on this property based on very conservative assumptions and with property management in place. If you don't want to be the operator of it, if you want to operate the property yourself, well, that's about $70,000 of income you put in your pocket for running it yourself as the vacation rental operator.
Yeah, and I'd also like to say too, people forget that outside of your tax benefits and outside of the obvious benefit of owning income producing property, which is the appreciation of the property, you're also winning two other ways. Is you obviously have your tax write-offs, you have the appreciation of the property long term, but if you get financing on a property like on this home here, let's say you finance half of it. So 1.7 million you're out of pocket for the down payment, some closing costs. The other, say 1.6 million or so is what you're financing. That loan is being paid off by your guests, if you think about it.
Sure.
So there is also equity you're building by virtue of the principal reduction on the loan as that property is still going up in value, and that gap is the equity that you're building. So you can put a number or quantify the amount of that debt that got paid off each year. That's tangible benefit, plus the return on your, the benefit on your taxes, plus the appreciation. And then you also now get to write off the interest on that. And obviously the first year's of your loan is mostly interest. So there's a big chunk of interest on that loan, probably about $120,000 of interest that you get to write off in addition to what you bonus depreciate.
So you get an appreciating asset while somebody else is paying for it, and you get tax benefits for it.
Yeah.
I mean, talk about a triple win. That's pretty awesome. Maybe we should buy this house.
Also, you keep in mind too, the missed opportunity cost that we started with in the front of this video. Even if you have the cash to pay, to buy this outright, why would you when you could have those extra two layers of tax benefits and principal reduction?
And this is what we were talking with Brad a couple weeks ago when we did the interview with the financial planner at Anders.
And that lady, when we were talking about that, was actually better off holding that mortgage on her home as well.
Yeah, because she paid cash, had a little bit of extra, and went on a cruise, and it put her in a different tax bracket. And so she actually had to take a HELOC out to pay the taxes when she should have kept the cash, and she should have kept liquid.
Yeah.
So
I don't think, to your point, people understand how much they don't quantify the missed opportunity cost. And so that cash could be doing so much more for you than just paying that house off outright.
Yeah, honestly, it's the only thing that I could see that would make sense. It's the emotional decision. It's emotional that, I don't want to have debt. I've reviewed my finances and my budget, and I can live off what I have, and I'm not going to do anything fancy. And it's just that emotional attachment to I don't want to have debt. Yeah. But other than that, from a business standpoint, it makes no sense because you have too many of these layers to benefit from.
Right.
I mean, who wouldn't want to buy a $3.3 million that's going to appreciate conservatively 8% that pays for itself with other people that you also get the tax benefits for?
And you can use it.
And they're booking 51% of the year, so the other 49% you're saying. So listen, this one is going to be sold by the time you watch this video, but if you want another one that qualifies for the same thing, reach out, because listen, we get phone calls, emails, text messages, Zoom invites every day from people just like you wanting to move to the beach. So whether that be in 2 days, whether it be in 20 days, or whether it be in 200 days, please don't hesitate to reach out. We'd love to be a resource and help you move to the beach. Thanks so much for joining us. Please make sure to hit the like button and subscribe for all the updates and notifications. And if you have a comment or a question, please put it down below, because I'd love to be able to answer it for you. And if you want to go through it and deep dive into this thing, reach out, call us, because we can do this. We have the spreadsheet that we're going to go through. Thanks so much for joining us, John. Thanks so much for joining us. Appreciate it.